Hey everybody, this is Braiden with Fulcrum Home Loans. This is your weekly update. It is Thursday, November 3rd, 2022. First point, the Fed met this week and they increased rates as everybody expected by 3/4 of a point. It's the fourth consecutive time that they've increased rates by 0.75%. It's interesting though, because people are really starting to feel the effects of the Fed rate increases. We know that it takes time from when the Fed does increase rates to the time that consumers feel those increases, and we're definitely starting to feel it. So there's been more and more talk about what the Fed is going to do moving forward. Are they going to continue to increase rates? Are they going to slow that down? So it's interesting that they kept with their strategy. That's going to affect home equity line of credit rates, credit card rates, car loan rates. Doesn't affect directly long-term mortgage rates, but it affects a lot of other things that touches consumers.
For sure. And that kind of leads us to point number 2. These meetings are almost no longer about the actual rate hike because we know that it's what's coming 3, 4, 5 weeks in advance. It's more about what is said at these meetings. And that was what was so interesting today or yesterday. They released their sheet that they always release at noon for us here Mountain Time. And it seemed like it was really positive, that they were going to slow down interest rate hikes, that they felt like we were finally getting this under control. The letter was awesome. But then Jerome Powell got up 2 hours later for the press conference and completely did a 180. He sat there and said, we need to keep raising interest rates. It's not in control. We'll probably raise them higher than we said we would in the past. And so this market, it caused more uncertainty. Right after the meeting at noon, we saw the stock market go up, interest rates come down, everything was looking really positive. As soon as he opened his mouth, everything started tanking again. I think there's a divide going on inside the Fed. The Fed is a board of people, and it looks like the majority of them think that we should stop raising interest rates because when they publicly all come forward and sign the letter, that's what it's stating. But Jerome Powell is the head of it, and he's kind of the snake that keeps biting them in the back and is going against them every single time he opens his mouth. And so it's causing a weird divide and a lot of uncertainty in the market.
GDP ultimately is a representation of what the economy as a whole is doing. So the Fed has a huge amount of power over how the economy as a whole is doing. So if the Fed, by their actions, by increasing interest rates, drives the economy into recession, which is not necessarily what they're trying to do, but what they're trying to do to cool inflation, then that would cause GDP to go down. That would cause us to potentially have a negative GDP, which 2/4 of those in a row represents an inflation by most definitions.
This is kind of a side tangent, but I feel like when I talk to friends, family, they don't really understand. Inflation is a benchmark of where prices were last year versus this year, right? So if something was $5 last year, it's $6 this year, that's a 20%, check my math, but 20% inflation. We have set a new benchmark. Prices are not, they shouldn't come back down from where they are. If we see 2% inflation next October, that means prices are 2% above where they are right now. I talk to a lot of people that say, hey, we need food prices to come back down and home prices to come back down, and they want to see prices back down before inflation was an issue. But by definition, that's not what it is. We're still going to see inflation. In fact, deflation is extremely dangerous for an economy, and we don't want to see that. And so people are complaining about these, but really what we want in the economy is for these prices to stabilize and become the new norm. We want the cost of a loaf of bread to be $1, even though it was 80 cents before. We want that to become the new norm and then just start increasing at 2% per year from here. We don't necessarily want deflation. Kind of a side tangent, but it's really important to understand what inflation even is and think about it logically. Prices, we don't want prices to drastically come down. Now, some of it will. Food probably will. Gas probably will. Some of those ones that have shot up exponentially will. But as an economy, we don't want negative inflation. That would be bad.
What's the difference between deflation and stagflation?
Stagflation is stagnant inflation, which means it is a prolonged period of high inflation where inflation keeps going. And so in the 80s, that was our issue, is we didn't raise interest rates high enough. And so every single year we were increasing 8% inflation every single year, which after 4 years, that's 50, 60, 70% inflation. So stagflation is when there's stagnant inflation and it lingers and we don't ever get it to come back down.
So are we in a period of stagflation right now?
That's the big fear. And the people that would argue with me, I think we should raise interest rates 50 basis points in December, 25 in January, February, and then just sit on it for 6, 12 months and let that lag happen to figure out what the true effects of all these rates are and then figure it out. If I want to play devil's advocate with myself, is people are afraid stagflation will happen and that many rates, and then we wait for 6 to 12 months, that we'll still be in the same boat of high inflation.
We can't get control of it.
We can't get a control. Yeah. We're back in the 80s and interest rates are up at 18%.
Yeah.
So that's the big fear. But the problem is if you overshoot it, we're in a recession. If you undershoot it, we're stagflation. Honestly, the Fed screwed this up when they said it was transitory inflation 2 years ago and didn't act. Now they're dealing with a dumpster fire that's kind of a lose-lose situation, and it's really, really fragile to get it back under check.
Third point is, along with interest rates increasing, is a strategy to help builders and sellers, and that's the buy down. In particular, that's the 2-1 buy down. A 2-1 buy down allows you to decrease your interest rate 2 percentage points from the current market rate. So if current rates are, let's say, 6.75%, your first 12 months, your rate would be 4.75%. Your next 12 months would be 5.75, and then starting in the third year, it would be again 6.75. There's a cost to do that, but that cost actually goes into an escrow account. If you ever refinance before the end of that 2 years, the borrower would get that prorated portion back, which is really, really cool. But this is a really cool tool for builders and sellers to use to help borrowers get off the fence, to buy their house, to buy their property, because it allows them to have a much lower payment for that first 24 months. We actually have a lender that just came out with a 3-2-1 buy down. So some lenders in the Valley are offering up to $50,000 for new home construction concessions. And so a 3-2-1 buy down would be a perfect tool to use for something along those lines. So a lot of different strategies out there to minimize the impact of higher interest rates. And we as a lender have those options to help our partners and consumers as well. 3-2-1 buy down is for anybody. It can be a builder could offer it in conjunction with a lender. I mean, lenders are the only ones that can actually offer it, but you need to have a builder or a seller who's willing to provide enough concession, enough money to be able to pay for that buy down. Borrower technically can do it themselves. I wouldn't advise it though, because we expect interest rates to go down next year and refinances are going to be more likely, but it's an opportunity to help get people off the fence. So 3-2-1 buy down lowers your interest rate 3% in the first 12 months. So instead of 6.75, it would be 3.75, and then 4.75, 5.75. Starting in the fourth year, it would be 6.75.
A 3-2-1 buy down is going to cost $30,000, $40,000, $50,000. It's going to be very expensive, but it's finally becoming a thing. CBH, local builder, just started offering $50,000 in concessions. And so builders are getting, I don't want to call it desperate, but they're wanting to unload their inventory, and they're getting more and more aggressive with incentives to buyers. And so buyers can start utilizing some of these tools. Seller concessions, what that means is the dollar amount that they give you to help close your home. So a seller concession is a dollar amount. So it's $10,000, $20,000, something like that. Where you apply that money can change. A temporary buy down is probably the most popular one right now, and in my opinion, actually makes the most sense right now because we believe interest rates are going to be down in the next 2-3 years. You can also do a permanent buy down. So if interest rates right now are 6.75 and you want to get down to a 6%, you could use that money to buy it down to a 6% forever. That's called a permanent buy down. You could also just have it pay like taxes and insurance and appraisals. They don't really care what you use it towards. It's just to help with your closing costs.
And that's been Brett and Braiden with your weekly update.